welcome back to The Lens. After a well-deserved break, Larry has been traveling all cities throughout the world, having ideas, dinners, sharing ideas all throughout the world that today we're gonna share with you. Remember, guys, we're in the top 10, and after this whole year, we did our tax loss basket. We started the Washington Pressure Points. We kept growing our Discord community. If you're not part of that, please reach out to info@thevirtualsupporter.com. This week, we have a special guest that I know you guys love. We have the Dr. Robin Van Battenborg and, of course, Larry McDonald. So, guys, go ahead.
Thank you, Val. Thank you, Valentina. And thank you for the team in New York for putting this together. It's great to be back. Above all, happy holidays. This is our last segment of the year. We really love this Lens program. We run a very, very special Bloomberg chat behind me with hedge funds, mutual funds, and pension funds in more than 20 countries, gathering intelligence, connecting the dots. The Dr. Van Battenberg is here. Thanks for being here, Rob, today. I think, Rob, the main thing of the week that I want to convey to everyone, and this is a big theme in our book, How to Listen to Markets Speak, about the great migration of capital. Think about what just happened, Rob. So the Fed is cutting rates and restarting QE with Atlanta Fed GDP at 3.5%. CapEx for 25 and 26 in artificial intelligence is up near $1.3 trillion. So they're easing into that kind of CapEx. They're easing into GDP at the Atlanta Fed at 3.5%. Plus core PCE, which is the Fed's inflation measurement, core PCE is at 2.8% versus the previous decade average of 1.5. Nowhere near the Fed's target, light years away from the Fed's target, 2.8%. And at the same time, fiscal dominance. So we're running a 1.8 trillion fiscal deficit, which is almost 6% of GDP. Trump's kind of forced to do that because the Biden deficits were bigger. And if you take down those deficits too much, you're going to really crash the economy. So think about that 1.8 trillion of fiscal dominance, 6% of GDP. Let's go back to Trump, 2017-18. Rob, they were running $700 billion deficits, a little bit more than 3% of GDP. So we've gone from $700 billion deficits, 3% of GDP, to $1.8 trillion deficits and close to 6% of GDP in 2025. That's driving this colossal migration into hard assets. In our chapter, we talk about in our book, we talk about gold, platinum, palladium, uranium names, hard asset plays, copper, and the power infrastructure to support artificial intelligence. Rob, what's your big takeaway from the week in the Fed?
Well, the overnight funding market, we've talked about this, and the Washington pressure points, and the turning points in the chat.
So those are your notes. So you produced the Washington pressure points and the turning points.
Right. Yeah. For weeks, we've been pointing out that there was a disproportionate amount of stress in these overnight funding markets. This is a $13 trillion market. This is where banks come to get their funding. And this is going back to the RRP, the facility that is
the reverse repo facility.
Right. That is basically on the sidelines, that was completely depleted. This last summer, Trump raised the debt ceiling, and Treasury Secretary Bessent had to come.
And Jose, can we get that overnight funding chart, please? Thank you. I'm sorry, Rob.
Yeah, so there's a long story behind this, but the bottom line is that these funding markets started to show real stress in October. And initially, the Fed looked the other way. And then they thought in the October meeting they could address this by stopping quantitative tightening as of December, but it didn't work. The stress kept on piling on. Banks had to go to the Fed window because they couldn't exit the funding markets anymore. And we were hammering on this every single day. The effective Fed funds rate went to 2019 levels, right? This is the last time. Remember, this is when Powell blew up the repo market. So they did a heroic thing. I have to be honest with you. I give them a lot of credit. So on Wednesday, essentially, they opened the floodgates with funding for the that market, that specific liquidity pocket, and they basically directed the New York Fed to buy $40 billion of T-bills every single month for the next 5 months. So you're talking about a $200 billion liquidity injection.
So Rob, how does that translate to the curve steepening here? Because so we're running the chat behind us. Institutional investors across the world are talking about this big breakout in twos, tens, that steepening. That's the steepest since Luke Palmer pointed out, steepest since 2022.
Well, we mentioned this for months that the combination of Hassett potentially becoming the new Fed chair would actually cause the curve to steepen because he's dovish, so he's going to lean on the front end and thereby sort of pushing up expectations in the rates market for either higher inflation or higher growth. And this is how you get the steepening. Now, the Fed added to that this week by buying $200 billion of T-bills over the next 5 months. This goes up top of the T-bills they're going to buy with the proceeds of the mortgage-backed securities they hold and that are maturing every month. So that means that roughly $300 billion of T-bills are going to be bought by the Fed. So they're going to pressure short-term rates lower by buying all this stuff. It's 5% of the outstanding T-bills. So the short end of the curve is going to be suppressed, and the long end, they're going to, it may run a little bit hotter because Trump is hell-bent on, pointing Hassett in the seat to replace Powell.
So what I find interesting, Rob, is you see this is the industrials versus the Qs. And you can't see it there because it's the long-term chart, but the bottom right corner, there's a big move this week, like a big, massive tremor before a quake. And if you look at the disinflation era, like from 2010 to 2020, we talk about this in our book, How to Listen When Markets Speak. That disinflation era, when there was certain deflation for 10 years in a row, the Qs outperformed the industrials. And now, lo and behold, we're into this fiscal massive overdose. And at the same time, we're easing policy into massive fiscal. So the fiscal and monetary response since COVID has been close to $17 trillion. And I find it very interesting that the industrials are now outperforming the Qs since 2020 in this kind of higher interest rate, higher inflation regime. So one of the things we've been recommending to clients is global value, EWU type portfolios, industrials, hard assets, companies that control assets. But I find it interesting, this move this week, a lot of people are talking about the industrials, big outperformance relative to the Qs.
Right. Yeah. Well, there's hardly any industrials left in the U.S., so they have some scarcity value. Part of the story with industrials is that they do benefit from AI investing, like GE Vernova and Caterpillar. So they piggyback on the spending splurge from the hyperscalers. But yeah, we've been talking about the complete void of industrials. I mean, one of the biggest components of the industrials is Uber. How is that an industrial? It doesn't make any sense. There's another big component of the industrials, which is I think it's Union Pacific Railroad.
Oh yeah, so Union Pacific.
Yeah, it's a big industrial component, but it's not really an industrial, right? It's a railroad. So there's a big shortage of industrials, and a lot of the industrials that are left in the U.S. have been splitting themselves up. United Technologies is a textbook example of that. GE has split itself up into multiple different components, which is great for sector-specific investors, but it basically shrunk the amount of large cap liquid industrials you can buy to a handful, and that is
Rob. See, that's the point. Right, that's the point. There's now 32 trillion in the Nasdaq 100, right? So the slightest amount of capital that goes. Let me give you an example. A year ago today, there was 290 billion in the gold and silver miners. 290 billion. Now it's about 610 billion. So the slightest amount of capital coming into these sectors, copper miners versus the Qs, copper miners up 82% year to date. It's not just AI and the power grid. It's the fact that if you add up every single stock in the COPX, it only comes out to 680 billion, right? So every stock combined in the COPX, which is the copper ETF, this is absolute madness. Every stock combined is 690 billion. Nvidia's 4.4 trillion. But in order for Nvidia to reach that growth path, these copper names probably have to double or triple from here because you need a lot more copper. You need a lot more infrastructure. And we had that warning today, Rob, big news warning today on the AI data center build out. So the bottom line is what we talk about in the book, the next 5 years, the growth path of AI for all the chip stocks, they need 830 data centers to be constructed over the next 5 years. That's the growth path. That's the expectation from Wall Street. About 830 data centers. Now, if that data center build out gets delayed because of NIMBY, not in my backyard, or power, any kind of delays, then all of a sudden the growth is in trouble. Rob, what happened today with Oracle?
Well, this is a story, right? So Oracle 2 days ago, they had a conference call and they said nothing about this. Their Abilene, Texas, a data center would, there were some rumors that there would be a little delay, but they dismissed it. Now they played hardball. This is Larry Ellison, right? And, I find him completely irresponsible because on top of expanding a CapEx by an additional 15 billion for next year. He's also in the midst of buying Warner Brothers, right? This is Larry Ellison's son, who is at the head of Paramount right now, who's using Larry Ellison's 40% stake in Oracle to try to buy Warner Brothers. Now, his competitor is Netflix, which is a responsible company, and they're very high. They have a strong balance sheet. So he has to now raise again the offer on Warner Brothers. This is going to be a 110 to 115 billion dollar acquisition, and he's hypothecated, I think, 300 million shares right now, in part to fund this deal. So he played hardball by saying, "Oh, I'm going to raise capex, this and the other. I'm going to do everything." And he thought that the stock would rip because in September, the stock ripped on a big RPO, which is what you're seeing here right now.
But Rob, there was the news today. The red headline was around the data center delay from 27 to 28.
I'm going to get to that.
Yeah. Okay.
So he played hardball by showing a huge order book, right? 523 billion and a ramp up in capex, which generally used to boost the stock. This time it did the opposite. They lost 11%. So he realized, okay, I got to slow it down. And that's what you're seeing here. He's blaming on equipment shortages. He's blaming it on labor shortages. I think that's a cheap shot because he could have said that 2 days ago and he didn't.
Yeah. So on the earnings call 2 days ago,
no,
they didn't mention any of this, and now they come up with a statement today.
So
what happened?
The hyperscalers are not mentioning this at all. CoreWeave did blame, some of the finished data center equipment frames on their delays, but that's very small. I mean, the bottom line is he didn't say anything 2 days ago. Now all of a sudden, now this is Bloomberg. I know, they're reputable, but sometimes they have their story wrong. So maybe Oracle will deny it. But if they don't deny it, it looks very suspect.
The biggest tech bulls in the chat. So we don't focus on, we don't like perma bulls or perma bears. We look at people when they're shifting tone. And in the valley behind me, in the chat, there's really highly respected bulls that have been really bullish NVIDIA, bullish the semis. They've flipped in the last month or so. And, it all comes down to there's three risks to AI for 2026 that are encroaching. It's like you said, it's the infrastructure equipment, but then it's the NIMBY risk, not in my backyard around. All it takes is 20, 30, 40 data centers to have that social pushback from political forces around the country. And then there's the power side, and that's why the SMR names have done well the last couple of years, small modular reactors. Rob, we had the ideas dinner last week, the ideas dinner in Palm Beach. And I noticed a couple of people at the table talking about natural gas and northern Texas and bringing those gas assets or bringing those data centers near the gas assets. Walk us through that conversation.
Well, the U.S. has a lot of energy, and part of that energy is trapped. So you have Western Texas, natural gas there is basically trading at negative levels. So you can get it actually, you get paid to use it. So unsurprisingly, a lot of the data centers are being built in Western Texas or in the Texas corridor. And there's one pipeline that is being built right now, but at Energy Transfer, that's ET, that's going to the west, to Arizona.
Rob, Energy Transfer, 8% dividend, and they've doubled the dividend over the last 5 years. That's where the money is. It's like the transfer of energy. But keep going.
You might wonder why natural gas went down 26%. Right, in the last week, because it has a nice run up, and then suddenly you have this massive pullback. And part of the pullback is LNG driven. So the natural gas story is a data center story, but it's more an LNG story as of now. And LNG demand, LNG exports soared in the last couple of months. In part because of looser regulation, Trump pushing LNG exports, trying to get the Europeans to buy U.S. natural gas instead of Russian. So that was a great story. But then there was a drastic flip whereby the Europeans suddenly cut back on their LNG exports. There was Freeport LNG, which is one of the terminals which got shut down because of a snafu. So the drastic pullback in natural gas is related to that. So if you like natural gas names, you might want to revisit them into this pullback. But it's like Jimmy Rogers said, there's like spending 1 month in the pit, natural gas pits, gets you more experience than a 4-year Harvard MBA.
Now, so once again, I find it interesting that Rio Tinto is outperforming Amazon over the last 3-4 years. And so what we're seeing is companies that control assets in this kind of like higher interest rate, higher inflation regime are starting to really pull ahead relative to the 32 trillion. Remember, there's 32 trillion in the NASDAQ 100. 3 years ago today was 12 trillion, right? So you've gone from 12 trillion to 32. Think about this. 11 years ago today, the NASDAQ 100 was about the same size, a little bit bigger than the energy space, right? So it was like 4 trillion versus 3.4. So it was 11 years ago today, it was 4 trillion in the NDX and 3.4 trillion in energy. Today, it's 32.4 trillion in the NDX and a little bit less than 3 trillion in energy. So we're looking at energy for next year. The positioning, Rob, has been so bear, like a lot of bears. The sentiment, the positioning is almost as bearish as you can get. And to me, that's potentially really bullish for next year when you get that kind of, and seasonally, November's always the last 10 years. November is the second worst month of the year. So you got a lot of tax loss candidates in the energy space, I think. But Rob, let's look at so here we have the S&P. So look at this. For 10 years, the S&P destroyed global value. And one of the points from the dinner last week, this is probably one of the best takeaways. When I see 3 people that don't know each other and they have the same view and they're highly respected. So over the years, in golf, like, who can hit the 250-yard 2-iron over the water? Like these are quality guys, and they're all saying the same thing. What they're saying is global value, global small cap value outperformed the S&P this year by double, right? And their point is, in years where that happens, it's never a one-off. The last 40 years, it's always been a 5, 6, 7-year trend. So that's color from the dinner. So global value, global small cap value. Here, the EWU the Qs or the S&P destroyed the EWU for 10 consecutive years, every single year. And I find it very interesting that once we entered that $17 trillion fiscal and monetary response since 2020 from both Republicans and Democrats, once we've gone into that regime, lo and behold, the EWU is outperforming the S&P since 2020, or at least in line, which is so that speaks to those type of companies in the EWU are global value. They own a lot of commodities, a lot of resources. Rob, what were your takeaways from the White House? Well, you were in the White House maybe a month or so ago.
Yeah, we visited the White House. We had a talk with one of the assistants to the Treasury Secretary. What are the main goals is, and we've seen, especially after the November elections, Trump pivot to this as well, is of course to improve affordability, right? Obviously the constituents are really laboring under, a burden of higher rents or home price appreciate, like a cost of living expenses. So this is one of the main topics. And we still expect that based on that conversation that they will announce some form of a national housing emergency, probably in the beginning of January, right? Of course, they have to prepare
in the midterm.
For the midterms, right?
Yeah.
So and cost of living expenses, affordability has become a number one topic, right? This is why Trump lost all these elections in the beginning of November. This is why Miami, for 30 years, there was a Republican in Miami, and that ended this week, right? They lost that seat. I'm talking about the mayor's race. So, Virginia, the flip was dramatic. The Republicans lost by 14 or 15 percentage points, right? A race that in 2021, they almost won. So they're going to have to address that. And one way to address it is suppress volatility in the rates market. Because right now, the spread between mortgage rates and the benchmark treasury yield is 200 basis points. If they can shrink it back to the spread that was there in 2012 or 2015 or 2007, you can have a 100 basis points or 1 percentage points decline in the mortgage rate. That really means a lot when you're talking about
right.
Homes in the tri-state area are probably now $1 million.
Hey, Jose, please go back with that. Please don't move the slides without discussing the slides, please. Rob, so what were you trying to say with that last slide?
Well, this goes back to the Fed, right? So the market, for some idiosyncratic reason, is pricing in lower amount of rate cuts than the dot plots are way too, I should say, hawkish still, right? So the market is pricing in a lot more rate cuts than the dot plot currently implies. And I think it's in part because Trump is on the verge of announcing a very dovish Fed chair to replace Powell in May. So right now, I think the dot plot is pricing in like 25 basis points of cuts.
So why should people care about this, Rob?
Well, the market is extremely still hell-bent on reacting on to rate cut expectations, right? So right now, the Fed has given us more or less an impression that, okay, we did this was a double whammy. We had the capital injections into the overnight funding markets, we cut rates, and now we're going to put it on a pause. Well, so for the market, they like the injections of capital, but they don't like the fact that there's the further rate cuts are in limbo. But if Trump comes in January and he appoints Hassett, that could actually increase the expectations of rate cuts for 2026.
But isn't listen? All I've heard from last month is that Hassett's a done deal. So why isn't the market pricing in more cuts for Hassett?
Yeah, I know. That's why this chart.
Yeah.
Right? Why is the market not pricing in? Now, they might say, okay, right now we're going through a lull, but the economy is going to rebound forcefully next year, and Hassett just doesn't have the room to cut. He might, but I still think he will cut 50 basis points. He's not going to just stay at 25 basis points. So maybe that's what the market is pricing in right now. But if look, he constantly repeats the 3% level as the appropriate level for Fed funds rates.
So what do you try to say? And this goes back, this chart should have been brought up when you were talking about liquidity. What are you talking about here, Rob?
Okay, one of the biggest drivers of stock market returns is liquidity, right? And it's very well expressed by the excess reserves held at commercial banks.
And Rob, I just want to say, please educate the Bitcoin crowd here. These lunatics have been talking about Bitcoin for years as if it's a fiat currency replacement. Sure, it is over the long haul to some degree. But at the end of the day, when you're long Bitcoin, you're just long excess liquidity. You have to know what the liquidity situation is. You have to track it and measure it, because once liquidity recedes, Bitcoin gets its doors blown off over and over again.
Right. Yeah. Yeah. I think Bitcoin this fall was a little bit of a special story, but it was mostly driven by liquidity, right? Which has rapidly declined because of a confluence of events that happened in October, mostly, the rebuild of the Treasury General Account by Scott Bessent. And the reason why we have to go into these plumbing issues is because liquidity drives things like Bitcoin performance, right? So every time liquidity goes down, Bitcoin goes down. Every time liquidity goes back up, Bitcoin goes up. It goes up with a lag, or sometimes it front runs this. The bottom line is that with the increase of the Treasury purchases that the Fed announced, the $200 to $250 billion liquidity injection, excess reserves will go up. They go up from this moment on until at least April, the end of April. So that could provide support under Bitcoin. Whether they'll realize it right now, I mean, Bitcoin got whacked, not just because of liquidity, but also because Trump, with his tweet on October the 10th, really knocked the bejesus out of the Bitcoin market, right? There was $19 billion of liquidations in the Bitcoin market on the back of that Friday tweet that came really as a shock to a lot of market participants. So from that moment on, market makers were forced to deleverage, and they were deleveraging in an environment whereby excess reserves were depleting rapidly. So it was a double whammy. So if you wonder why Bitcoin went from 125,000 to 82,000, that's why the confluence of these two big events. Right now, the Fed is trying to reverse that.
And what are you trying to say with the 2-year swaps here?
Oh, 2-year swap spiked because of this Fed action, right? Because by buying all these cash treasuries, the spread between the swaps, which have been trading at a premium is narrowing, right?
So the Fed announces they're doing QE, they're going to buy T-bills, and that triggered that move.
Exactly. So using the swap market also to predict as a predictive factor for what the Fed will do with asset purchases, right? Because when the Fed ramps up asset purchases, swap spreads spike, right? So you can actually gauge market expectations of the Fed asset purchases. So that's a very useful tool as well.
So you talk about, so with Washington pressure points, this is our new note. What happened was, after the April move, where our trading partners globally started to trust the US a little less, we had probably 15 or 16 pension fund clients or all kinds of institutional investors around the world. And they came to us and they say, listen, we want a weekly piece that looks at treasury issuance, that looks at the RRP, the reverse repo facility, looks at liquidity. And that's why we created Washington pressure points, right? But what does Washington pressure points do? Like, what's in it for the customer?
We take a very close look at Washington, right? All the moving parts there. So the Senate stuff, the House, the executive, what Trump is doing, his plans, his actions, and the Fed. Those are the three major moving parts, and sort of translate them into what are the market implications, right? What are the implications for the markets of the Trump tax cuts? What are the implications of Fed policy? Either Fed cuts. What's happening? Why would what is the Fed response to things that happen, for example, in the overnight liquidity market, right? What are they trying to do? How far are they? What's the stress in this market? Why should they react to this? And what is the possible path towards a reaction? The legislative, what's the Senate? An important piece of legislation when it comes to Bitcoin is, of course, the Bitcoin Act, right? The Bitcoin Act is now...
Is that the Genius Act?
What, sorry?
The Genius Act?
No, that's the Bitcoin. No, that's different than the Genius Act, which in and of itself is, but that was passed.
Yeah.
So the Genius Act implementation is very important for things like stable coins, and it's also a facility to inject liquidity into the bills market, right? Because every time a stable coin is issued, they have to buy the equivalent of a T-bill. But that was passed. But now you have the Bitcoin Act, and the Bitcoin Act is a piece of legislation that allows the U.S. government to buy 1 million Bitcoins, right? There are only 21 million outstanding ultimately, but they're buying 1 million Bitcoins. So it's 5% of the Bitcoins outstanding over the next 5 years. Once that piece of legislation is passed, it could be a catalyst for Bitcoin, right? It's right now waiting, and it's been waiting for a while, but people suspect that this is going to be a beginning of 2026 event.
Right. And so as we look into the new year, 72 trillion in US equities, and then look at the rest of the world. I mean, it's an absolute. So remember, I think the biggest point into the new year is, first of all, we have our tax loss basket. Anybody that wants a look at that, info at thebeartrapsreport.com. This is going to be one of the best years ever for tax losses, because when you have 32 trillion in the NASDAQ 100, this, like I said before, the smallest amount of money moving into areas where the equities are just really small, it just creates this massive, massive opportunity, because the slightest rotation into value or into global value or into precious metals or into copper names and natural gas names. Look at the natural gas ETF. Every stock combined in the FCG ETF is probably $460 billion, right? And that's the natural gas infrastructure to support artificial intelligence. But at the end of the day, there's trillions and trillions of dollars in the chip stocks, and none of the stocks is in the infrastructure to support the chips and the energy. So to us, that sets up really a spectacular opportunity for 2026. Info at thebeartrapsreport.com to get our best ideas for next year. But Rob, Merry Christmas to you. Merry Christmas to everyone. I'm so grateful. We had a record year at the Bear Traps Report. We nearly doubled the S&P 500's return, and I'm grateful to the team and everyone in New York. I've been on the road this year. We did ideas dinners over the last 18 months in Zurich, Geneva, Puerto Rico, Palm Beach, Sarasota, all the way up to New York, Toronto, LA, San Francisco, and we gather that intelligence in the chat, in the dinners, and we wanted to democratize that information and share it with our friends and our clients. So info at thebeartrapsreport.com to get that lens. You want a lens on a buy-side conversation. You want to know what are the professional investors, the most elite investors in the world doing. And you can find out by reading How to Listen When Markets Speak. Reach out to info at thebeartrapsreport.com. Rob, thanks for everything. Any parting words? What are you doing for Christmas?
Trying to take it easy.
Yeah.
Waiting for the new year. We're probably coming out with some ideas on the New Year's. What markets are going to look like. What are the opportunities? What are the risks? Right. It's going to be a very exciting year. It's going to be another election year. There's a lot of you got your Olympics. You got your World Cup this next summer. You got a bunch of legislative issues in Washington, D.C. So there are a lot of moving parts to that year, and especially, of course, with the AI trade.
We should probably look at Nike, with everything,
Right.
next summer. That sounds really interesting. Well, great, Rob. Thank you, Jose, Valentina, the entire team in New York, the production team, and we'll see you next year.
Bye-bye.
Thank you, Larry. Thank you, Rob, as always. And thank you to our viewers today. We see you, we appreciate you, and thank you so much for joining us this year and for supporting us. As Larry said, our whole goal at the Virtual Report is to democratize information and make it as easy as possible for the investor. So if you're interested in our turning point, which is our weekly macroeconomic recap and overview, our tax loss basket, we also have a trade alert performance report that just came out. I'll be more than happy to share it with you. And then again, as Rob said, we released the Washington pressure points a few months ago, and it's kind of a one-stop shop for treasury issuance, H1s, liquidity, and it kind of shows more than the 15 years of experience that we have on the Hill. So if you're interested in any of that, do not hesitate to reach out to info@thevirtualreport.com. We'll be more than happy to assist you. Have a happy holidays.